Alright, so welcome to lesson 6, Psychology of Winning Traders. So at the beginning of this course, I talked about what makes a successful trader. And again, it's not just what I say, but an interview with the top traders in the world in this book known as Market Wizards has found that all great traders have 3 things going for them. And the first thing is, again, you've got to have a trading system with a positive statistical expectancy in the markets that has an edge in the markets. And that's what you've learned in this course. You've learned proven strategies that have got a statistical edge, that you know that if you continue to use the strategies, your wins will be more than your losses, your average win more than your average loss, and you will always end up with a profit. So it's kind of like a business with a proven franchise system that you now have, okay? Now at the same time, you know that no matter how good a trading system is, it can't win all the time. There will be periods where it goes through losing trades, right? Sometimes even 5 losing trades in a row, or 5 winning trades in a row. So the second thing is to size your position in such a way that you risk a small percentage of your capital. So in the event of a string of losing trades that are inevitable in any kind of business, you don't get wiped out, right? It keeps your losses small so you can continue trading until your positive edge benefits you, okay? So what's the third thing? And again, I've said this many times that 60% of your success as a trader, majority of your success is not the trading system, it's not your position sizing rules, but it's more your psychology, something which is very qualitative. And again, if you read many books on trading, you watch many videos, all of them talk about trading system strategies, and these are the ones that get the most liked. These are the ones that are shared the most because it's easy to understand, it's easy to apply, it's quantitative. But again, what people don't understand that the most important key is not the quantitative part, it's the qualitative part, something that is really hard to teach. Well, you can teach it, but very few people can teach it well. But it's something you have to learn and you have to practice until you embody it. And that's really the trading psychology. And I found over all my years, I've taught 2 people the same strategy, the same system, but they both produce very different results. There are some people who become multi-millionaires, they become professional trader, they make consistent profits every month, and another guy blows up his account time and time again. And what was the difference? They both learned the same system. The difference was the psychology they had, the ability to manage their emotions, the ability to constantly execute the trades without fear, hesitation, reservation, okay, or expectations. So I'm going to talk about what is the true psychology you need to have to succeed in this business. So again, let me reiterate that psychology is more important than strategy. And winning traders are different from losing traders, not because of some kind of magic indicator they use or some kind of technical knowledge they have. What amazes me very often is people write me emails and they always ask me, Adam, what indicator do you use? And I say, I use this indicator, I use moving averages. And they say, I also use moving averages, how come I lose money? It's not the indicator you use, it is how you use it. Okay? Or they ask me, they say, do you use Fibonacci, do you use this, do you use that, right? And I say you're asking the wrong questions because it's not about the magic indicator. What makes winning traders different is the mindset they have towards trading. So understand that the best strategies and the best indicators will not help you to succeed if you have the wrong mindset towards trading. I'm sure you've heard of this term. If you have not, it's called the holy grail of trading. Right? So most newbie traders, they go around in circles, running around the mulberry bush, searching for the holy grail. And the holy grail is an idea that there's some kind of magical indicator or magical strategy that will work all the time, under every market condition. They will always win, they will never lose, right? And so what they do is they take a trading course, they read a trading book, sounds exciting, and they trade it, may make money for a while, but eventually they lose money, and they say it doesn't work, let's go try something else, all right? And sure enough, that doesn't work as well, they try something else. So they keep jumping from strategy to strategy. They say, okay, let's do trend following, doesn't work. Let's do mean reversion, doesn't work. Let's trade on hourly candles, that doesn't work. Let's trade on minute candles, that doesn't work. Let's trade on Forex, that doesn't work. Let's trade on stocks, that doesn't work. Let's trade on futures, that doesn't work. Let's trade on options, that doesn't work. And they spend all their money going round and round in circles, reading all kinds of books, all kinds of seminars. They say, everyone's making money except me. Right? Because they're searching for this holy grail. It doesn't exist. Okay? So, again, it doesn't exist. All right, there's no holy grail indicator or strategy that can predict the market and win all the time. All right, it's not about that. So the secret to trading success again does not lie in an amazing theory or indicator. The secret lies in the trader's mind. And I know I keep saying this again, it's in your mind, right? But what do I mean by that? I'll get into it. Hold on for a while, right? So let me quote Jesse Livermore, who is one of the greatest traders that ever lived. If you've not read about him, go online and read about Jesse Livermore. He made hundreds of millions of dollars in the Great Depression, in the crash of 1907, right? And in 1907 and the Great Depression of 1929, hundreds of millions of dollars was a lot of money, right? It was equivalent to hundreds of billions of dollars today. So he was the greatest trader that ever lived. And his quotation that really struck a chord in me years ago was this quotation. He said, "The answers to the question of successful trading are to be found in the trader's own mind." So he said this kind of like, 80 years ago, 100 years ago, right? And it still applies today. Those who seek answers from the latest invention of trading systems or tips will not find the answers because they have not understood the question. Right? That sounds really deep, but it's true. Jesse Livermore. So let's get into the specific understanding of the psychology to win in trading. And the first thing is you gotta have tremendous discipline to be a winning trader. And what do we mean by discipline? Discipline means you trade according to your predefined objective entry and exit rules, right? Based on your trading plan. So in the lesson on the trading system of impulse pullback, impulse pinback, I've given you the trading rules, right? What are the entry rules? What are the exit rules? And you have to follow it precisely. So only when the rules are met, when this happens, you take a long entry. When this happens, you exit the trade. And most of the time, the exit is automatic because of your fixed stop loss and your profit target. So you don't intervene and change it once it's been set. You never trade based on rumors. Never ever do that, right? Like you heard a rumor that, the Fed's going to increase interest rates, so the dollar's going to rally. You've been hearing that in the news, so you're going to buy the US dollar. No, it doesn't work that way, right? And never buy based on the opinions of other people, where you've got gurus, on CNBC or on whatever it is, and they say things like, the euro's going to tank this year, the US dollar's going to reverse, and based on that, you think, okay, the euro's going to go up, so I shouldn't take this long trade on the euro, right? I should go short. No, you don't do that, right? And never trade when you're emotional. That's when you make all the mistakes, right? Never trade based on emotions, like going because you say, I feel this is going to be a winner, or getting up because I think it's going to reverse, right? If you do that, you will never get consistent results. You have to trade according to your entry and exit rules that are objective. And again, you got to have the discipline to stick to your chosen strategy through the wins and losses. Right? A lot of people, the moment they go through a losing streak, which is again inevitable, we all go through that, 4 losses in a row, 5 losses in a row, there's this overwhelming temptation to tweak their rules and say, you know what, it's not working now, so let me go change something. And they mess up their entire statistics. Right? You got to stick to your exact strategy without changing anything. Again, avoid listening to the opinions of experts who can predict the market based on insights and news. Why? Because no one can predict the market. Remember that what drives prices up and down every day is demand and supply. Okay? And demand and supply is driven in the short term by emotions. In times of fear, people sell. In times of greed, people buy. Okay? Now, can you predict people's emotions next minute, next hour, next year? You can't. I can't even predict my wife's emotions, okay, every day, right? She can go to bed happy and she can wake up the next day in a bad mood. So if I can't even predict one woman, how can I predict millions of traders in the world? It is impossible, right? So you can never predict what's going to happen. At the same time, even if you can predict tomorrow's newspaper, even if you can predict what the Federal Reserve will do, you can't predict how the market will react to it. So it is a waste of time to do that. All you got to do is to follow your rules that have a positive statistical edge. Okay. The next thing is to think statistically. What does it mean? Remember that a winning strategy is a winning strategy because, right, it has got more wins than losses. The average win is more than the average loss. That is what creates a positive statistical edge. You've learned that before in lesson 2, right? But even if your trading system has a win rate of 60% or 70%, 50% it is, that's going to make you money, It doesn't mean that in every 2 trades, there's going to be 1 win and 1 loss. It doesn't mean that in every 10 trades, there'll be 6 wins and 4 losses, or 5 wins and 5 losses. It doesn't happen that way, right? In a small number of trades, in 5 trades, 10 trades, it is completely random. Remember, you can toss a coin 10 times and get 10 tails in a row, even though the probability of a heads is 50-50, because in a short term, it is luck. Right? So in the short term, the results you get are pure luck. But it's in a large sample of trades that it's got nothing to do with luck. It's got to do with the law of large numbers, and it's got to do with statistics and probability. So the point is, when you get a series of wins in a row, like for example for me, last month, September, was a fantastic month. I had something like 90% win rate on my stocks and my forex, right? But I'm not going to let my head get too big, because I know that, you know what, it's not going to happen forever. I'm not going to get 90% every month. Okay, so when you have a string of wins, don't be too happy and raise your risk and take more trades because you think you're on a streak. At the same time, when you've got a series of losses, don't be fearful and say, you know what, it's not working now. Let me not trade as much. Let me not take this trade. Because the moment you get emotionally affected and you don't trade according to the rules, that's when you do not optimize your performance. Okay, so always remember that a good trade can end up as a loss as well, even though you follow all the rules. So focus on following the rules and not on the outcome of each trade. As long as you have an edge and your average win is more than your average loss, you will be profitable over many trades. So I never think of the outcome of 1 trade or 2 trades. I always think of the next 50 trades at least. What's the next 50 trades? I know that in the next 50 trades, I will definitely make money. It's almost 100% guarantee I will make money in the next 50 trades. 5 trades, maybe not. Maybe, I don't know. But 50 trades, I will always make money. And when you think statistically, you don't get stressed up when you have a few losses or wins. Okay? Next, patience. Patience. Okay? It is something you gotta inculcate. Most important thing is patience. You only trade when there's a high probability opportunity, when all the stars are aligned, when all the conditions are met. Easier said than done, I can tell you for most people. Because for most people, they enjoy trading, and so do I, right? But you should never come to a point where you say, today I gotta take a trade, I'm bored, right? But there's no trade signal. Now my that looks like a trade signal. It's not exactly, but never mind, let me just take it anyway. Okay, and then you start to trade when there's no clear signal. Why? Because you're bored. Okay, or you feel that I got to do something, right? I looked at the market the whole day, there's no trade, but I got to take a trade to do something, right? Never think of quantity that I've got to take a trade. In trading, I keep saying that not doing something is as important as doing something in trading. Not doing something is doing something in trading. And in trading, there are always 3 things that you can do. You can go long, you can go short, or go fishing. It means do nothing. And sometimes it is best to go fishing. Okay? So understand that. So again, when the rules tell you it is not time to enter, do nothing. Again, knowing what not to do is as important as knowing what to do. Okay? And again, next thing, focus on what is happening in the market. Is the 6 EMA crossing above the 18 EMA? Is the price making higher highs, higher lows, lower highs, lower lows? Focus on the price action, what's happening in the market, and make decisions based on that and not why it is happening. What do I mean? A lot of people waste their time trying to figure out why the market moves a certain way, right? So they see, hey, the market's on an uptrend, they go long, 6 EMA above 18 EMA, and suddenly the price comes down, hits their stop loss, and they go, what happened? And they go search online, what happened? Did someone make an announcement? Or, what happened, right? It's a bloody waste of time asking why it happened. It happened. Move on to the next trade. Okay? Remember that price movements are not caused by public news. It's caused by the market's interpretation of the news. And you will never know how the market interprets the news until after the fact. And analysts always like to explain what has happened after it has happened. So would you rather care about the explanation why it happened, or care about catching the trade or catching the trend in real time? To me, it's about catching the trend in real time and making money, not about understanding why it happened. Okay? It's like recently, North Korea, they fired a missile across Japan, or over Japan, right? And what happened? The yen, the Japanese yen went up. Sorry, yen went up, right? And people say, oh, doesn't make sense, right? The yen should go down, okay, because Japan's in trouble. They fired a missile across Japan. But when the yen went up, what happened? Analysts would then attempt to explain why it happened. They say, oh, the reason the yen went up is because the Japanese yen is a safe haven. So in times of potential crisis and war, people buy the yen. Yeah, right, bullshit. It could be a million reasons why the yen went up. I don't know why. But there's no point in asking why it happened. Okay, don't waste your time on that. So avoid associating market trends with news events. So I keep telling my students, there's no point attempting to predict the market, the news, right? The only thing that I do with regards to news is to look at Forex Factory and look at the upcoming red news reports. I mean, what could potentially move the market when news is released? And I avoid taking a trade before the news report. And I always exit my trades before a big red news event. That's the only thing I do. I don't bother to interpret it. I don't bother to understand it. I just get out the way, let it do what it's going to do, and then get back into the market after that. Okay, number 5. Do not predict the future. I mentioned this earlier. Again, it's impossible to predict the future, and the market is driven by crowd psychology, so avoid listening to experts who give predictions of the future or to predict it yourself, right? As human beings, we can't help but having opinions, right? I have an opinion myself. I think that the US dollar is going to rebound. I think that the Dow is going to continue going up for a while before it collapses, right? But I never trade based on my opinions because it's just an opinion. And my opinion is as good as anyone else's opinion. It's just an opinion. Might as well just flip a coin to get the coin's opinion, all right? So always trade based on the current trend or reversal in trend and not to attempt to predict the trend, okay? Predicting the future clouds our judgment and makes us less willing to take losses, okay, because of the ego of wanting to be right, or makes us less willing to take trades when it goes against our own judgment, right? So for example, if you think that the US dollar will go up, it will go up, it will go up, and there's a short US dollar trade on the strategy, you won't take it because it goes against your judgment, and that could turn out to be a winning trade, okay? Number 6, risk management. All right, a lot has been said about this under the lesson on position sizing, okay, but I'm going to reiterate it again under psychology. Remember that there's no trade that's a guarantee to win. So we always risk a small percentage of our capital, which is 1% to a maximum of 3% on any given trade, and we only enter on high probability trades where your profit target and stop loss is always preset. And once it's set, you never ever intervene. Never. Okay, I can tell you that. When I first started trading many years ago, I committed all these mistakes which I'm telling you not to do right now because it's human behavior, right? It's emotions. And my mentor told me at the time, same thing, don't move your stop loss. Okay, don't take profits too early. Enter when the rules are met, right? I said, yeah. Okay. And guess what? I broke the rules, right? Like most people. And I can bet you will break the rules until the market slaps you hard enough. They say, okay, I better listen to Adam Krug. So what happened was, I broke the rules when I first started trading like most people. Because, emotionally it's so tempting to move your stop loss and your profit target. And when I started losing money, I started saying, okay, shit, I gotta start following the rules. And one of the things I did was I asked my wife for help. I said, darling, if you love me, you do something for me. And I told her this. I said, the next time I break any rule in trading, you're going to give me a tight slap on the face. And she did. She gave me one big slap on the face, right? And, I hate running. I don't like to exercise very much. So I did something. The moment I break a rule, I'll run 5 kilometers, and I bloody hate running, right? So after I run, I feel the pain, all right. And that kind of conditioned me to now never ever break the rules, to follow the rules completely. So I hope you follow it right now, but in the event you don't, you have to condition yourself with some kind of pain, all right? So that's risk management. Now, the next thing is this. Now, I can tell you this, that to be a winning trader, you must have an extremely high level of confidence. You must be extremely confident. And confidence is a state of mind. Now, what do I mean by confidence? Confidence means having the confidence to follow your trading strategy through the wins and losses, no matter what. You follow the system to a T without intervening, without changing anything. Okay. A lot of people have the wrong idea about confidence. They think that confidence comes from the outcome of a particular trade. So, for example, they put in a trade and say, okay, this one's going to be a winner. I'm confident now. That is the wrong confidence. I can tell you that whenever I put on a trade, I tell myself that I've got no idea what's going to happen. It could be a win, it could be a loss. Because every outcome individually is random. Right? The market's random. Okay? And the trouble is, if you go into one trade and say it's going to be a win and you expect it to be a win, it's very dangerous. Because when it turns out to be a loss, how do you feel? You feel like crap, right? You feel disappointed. You feel upset, right? And the moment you get disappointed and upset, it screws your psychology for the next trade. Okay, so it's important that whenever I go into a trade, I tell myself I've got no expectation. I've got no idea what's going to happen. In fact, I imagine it's going to hit my stop loss, and I'm okay with it. Ironically, that is confidence. Because confidence comes in knowing that even if you've got 1 or 2 or 3 losses, it doesn't matter. Because over the next few trades, you're going to make it back and a lot more. That's the confidence. Okay? So again, the confidence comes from knowing that your trading plan and strategy has a positive expectancy. And this comes with, again, a lot of back testing. If you have not done back testing, you can do a lot of back testing. Or do a lot of paper trading until you find that, hey, this system works. And once you trade live, then you have got to condition your mind to have the same level of confidence. All right? So it is critically important to understand the difference between good trades, bad trades, and winning trades and losing trades. So what's a good trade? A good trade is one where you follow the rules of your predefined strategy. Now that's a good trade. Okay, a bad trade is a trade where you broke your own rules. So could a good trade be a winning trade? Of course. In fact, most of the time they are. Right? But could a good trade be a losing trade? Yes. Okay? So a good trade can be a winning trade or a losing trade. Executing good trades consistently assures long-term success and repeatable long-term profitability. So I find the biggest mistake that losing traders make is when they've got a losing trade, they say, oh, it was a bad trade. No, it was not a bad trade if you followed the rules. Right? But if you didn't follow the rules, then it was a bad trade. At the same time, understand that a bad trade, one that you broke your rules, could turn out to be a winning trade as well. So when you break the rules and you have a winning trade, it may feel good in the short term, but it is extremely damaging in the long run, because what that does is it reinforces bad habits, right? So say you broke your rule and you shifted your stop loss, or you broke your rule and you entered when there was no clear signal and it was a win. You're going to be very happy in the short run, but in the long run, what's going to happen? You can be tempted to do that again. If you keep doing that bad thing of changing your stop loss, of entering where there's no clear signal, in the long run, you always end up as a loser. Okay, so the idea is to just do good trades and let them be wins or losses. This is not within your control. What is within your control is to only do good trades. Managing your emotions. Now, I always say that as human beings, we're driven very often by our emotions, not by logic. Okay, and that's the reason why most people get into trouble. It's like, logically they shouldn't smoke, logically they shouldn't overeat, they still do. Why? Because it feels good, right? Or logically they say I should go to the gym, but they don't go because they feel lazy, right? So I can tell you that to succeed, not just in trading, but in any aspect of your life, is your ability to manage your emotions, the ability to control your emotions and not let your emotions control you. That's the key to success in relationships, in business, and in trading. Now, remember that when you trade, you will be facing a whole host of emotions that will come out that is tied to money at stake in your account. Okay, emotions like greed, it will come out, trust me. Fear, doubt, hope, excitement, frustration, uncertainty. So to be a winning trader, you must learn to think and act contrary to your natural instincts or your natural emotions. Why? Because most of our emotional patterns cause us to lose money. When we are conscious of these patterns, then we can overcome them. You see, as human beings, we all have the need to avoid pain and the need to get pleasure, okay? And that's an instinctive need. But it is this instinctive emotion that causes 90% of people to lose money in the markets. Why? See, the fear or the need to avoid pain causes you to what? To not honor your stop loss. So say you enter and it hits your stop loss. You're supposed to sell, to get out, take your losses, right? That's the logical thing to do. But emotionally, people can't get themselves to do that, because if they do that, they've got pain. The pain is taking the loss. So they say, you know what? If I don't sell it, I've not lost it yet. It could still come back. So because of this hope and the need to avoid that short-term pain, it causes them to hold on to losing trades. So as a result, when they lose a lot, because they didn't take the loss when it was small until it balloons that it goes out of control. At the same time, the moment they got some profit, they say, let me quickly take that profit to get some instant gratification, to feel good about it in case I lose it. So because of that, people tend to take profits too fast and allow losses to become too big. And that's what causes most people to lose money, because of these natural instincts to avoid pain and to gain pleasure. So you must be conscious of these emotions, these patterns, and to go opposite of these patterns. So how can you manage your emotions? I always say that you only trade at your best at a Zen state, when you trade with zero emotions. Now, I know that's not easy, but here are a few ways to trade without much emotions. Number one is you must trade at a level of capital or risk where a few losing trades does not hurt you emotionally. What do I mean? So what I'm saying is this. So a lot of people say, Adam, I should trade with 3% risk, 10% risk, because logically they'll make the most money. Yes, logically, but I can tell you emotionally, you must always start with 1% risk. All right? Because when you trade 1% initially and you get, say, 3 or 4 losing trades, a 4% loss in your capital, for most people, no big deal. Okay? But if you trade at, say, 10% risk and you get 4 losses, as a 40% fall in your capital, most people after that, they get upset, they get angry, they get fearful, and their hands start to shake before they place the next trade. And the moment you get emotional, you cannot trade. Trust me, the moment you're emotional and you trade, you will end up losing money, or you're going to compound your losses. Okay? So trade at a level of risk where losses don't matter. Now, I even have some people who, now all this depends on your risk threshold, of course, your emotional threshold. To some people, they can lose 30% and say, no big deal. 50%, no worries, mate, right? But to some people, when they risk 10%, they freak out. So if you're the kind of person that loses 5% and you freak out, then don't even trade at 1% risk, trade at 0.5% risk. So you have to lower your risk at a level till it doesn't affect you anymore. And you get so used to it, then you raise your risk level, right? It's like conditioning yourself. Does that make sense? Okay? Same thing. You may have 100 grand to place in your account right now, but I don't suggest you place 100 grand. I suggest you place a level of capital like 5 grand or 10 grand where you lose half, you don't care. Then you can trade optimally. And only when you can trade optimally can you then raise your capital and raise your risk. Okay? So let's take a look specifically at how the different emotions will affect you, so how you can be aware of it and to not allow it to overcome you. This is one of my favorite cartoons when it comes to trading, right? So in this cartoon, it perfectly captures how human emotions actually causes us to perform worse than random chance. All right. So in this cartoon, you can see this guy. He said, "I just wiped out half my account in 10 minutes." All right. And this monkey says, "I just made 80 pips." And this man says, "But I've got a PhD in economics. I'm a smart guy. I'm a professor, and you're just a random monkey." And the monkey says, "And since I have no concept of money, I act without fear, without hesitation, without reservation, and that's why I can do it, right? If I were risking bananas, it would be a different story." And that is why the irony is that I can tell you that, sometimes the more highly educated a person is, right, the more PhDs or they've got economics background, finance background, the more they can't make money as a trader, right? Because when you've got all these qualifications of finance, economics, and by the way, I do have these qualifications, right? I majored in finance, I majored in economics, I scored straight A's in economics, right? But the moment I came into the market, I realized that my training in economics and finance was not helping. In fact, it was getting in my way because it caused me to have an ego, right? To think that the market, in the short term should behave according to economic and financial principles, and they don't. right? The market moves according to collective psychology. So the way to trade successfully is to have no ego, no expectation, and to just trade based on your rules, okay? And to not have this fear that most people have. All right, so let's take a look at specific emotions that's going to affect you as a trader. The first one is greed, and greed is a big one because most of us go into the markets because we want to make money, right? So we have a certain level of greed, but you can't let the greed overcome you, right? It's kind of like what Jim Cramer says on TV, CNBC says, bulls make money, bears make money, but pigs get slaughtered, right? So if you're a pig and you're greedy, eventually you're gonna end up blowing your account. So greed may cause you to raise profit targets too high and to stay in the trade too long. This can cause future winning trades to become losing trades. So here's a typical example. So say you went long over here and you had a profit target of 1.5R. As you've learned in most of my lessons, that is my usual profit target for Forex 15-minute candles. And the moment you enter, whatever the price spikes up, hits your profit target, you get 1.5R, which could be whatever, right? You know, $500 or 1 grand or 5 grand or whatever money you made, and you feel, well, great, made the money, right? But guess what? The moment it hit your profit target, the price continued going up, going up, going up, going up. Say, shit, if I stayed in the trade, I would have made, instead of 500, I made 5 grand or 2 grand or 4 grand. So why did I take profit at 1.5R? You know, what's the deal, right? And guess what happens, right? And you start to have this thing called regret. All right, you buy there, right, hits your profit target, goes up, and you have regret. You know, I should not have sold too early, should have stayed in the trade. So the next time, you know what, I'm not going to have a profit target, no profit target, or I'm going to put my profit target at 2R or 4R. And oftentimes I get emails and people ask me, Adam, why do you put your profit target at 1.5R? Why not 2R? Why not 3R? Why don't you put a trailing stop loss? Hey, you think I'm stupid? You think I don't want to make more money? All right, I've been trading for 26 years. Don't you think I would have thought about it? Duh. Okay. Sure, when you see the price running, you think I could have been there. But I can tell you it doesn't happen all the time, right? When you enter a trade, you don't capture a great trend all the time. In fact, that is the exception rather than the norm. Most of the time, after you enter hits your profit target, you go sideways or goes down or whatever can happen. So you cannot take one event and generalize it. And the danger by doing that is that if you put your profit target too high, like for example, in this case, you say, okay, I'm going to put my profit target at 4R. No 1.5 for me, I'm going to put 4 or 3R, put a trailing stop. Guess what's going to happen? Sure enough, the next trade is going to go up. It's going to hit maybe 1.5R, right? And then, right, goes down, turns out to be a losing trade. Or break even, for example. And instead of getting your 1.5R, you got 0, you got -1. And trust me, that happens, all right? So stick to your profit targets. Now, I'm not saying that you have to put 1.5R. It depends on your strategy, right? So in other strategies I use, I may put a 2R target. Or for example, when I trade stocks, in certain cases, I may even have a 4R target. It depends on the strategy. So what I'm saying is in this particular strategy, which I use in Forex, which is the impulse pullback, impulse pin bar with 50-minute candles, I found 1.5R is the optimum for this strategy, okay? But I'm not saying that it must always be 1.5R. Okay, just bear that in mind, right? So again, you can see in this case, the win becomes a loss because too high a profit target, you know, or you didn't get out. Okay, good. Next one is fear, all right? So fear, let me give you an example of fear and frustration, okay? So let's imagine you place your buy order here, okay? Your stop loss is there, so that's 1R of risk. And your profit target is 1.5R, okay? Great. So say you take this trade, right? You enter here, it goes up, right? And it almost reaches 1.5. Doesn't reach 1.5. Say it reaches 1.3R and goes down. And you end up with -1R loss. How do you think most people will feel? They feel a bit upset, right? Like, damn, I had 1.3R in my pocket and it was gone. Never mind, let's go for the next one, okay? Control my emotions. So next time, you go in again and you buy and it goes up and say now it goes to say 1.2R. or 1.1, whatever it is, and then it goes sideways and goes down again. And damn, lost another trade, 1 hour loss. Now I get a bit frustrated. I had 1.3 in the pocket, it was gone. 1.2 in the pocket, it was gone. I was so close to my profit target. Let's go for the next trade, right? So the next trade, you go in and you buy, and it goes up, and say again it hits 1.2 or 1.3, goes sideways, and you go now lost again, right? And I can tell you that for most people, after it happens 3 times, they're gonna say, you know what? They start to get upset, right? Because they say, if I had taken my profit at 1.2 or 1.1 or 1.3, I could have had 3 small wins instead of 3 losses, right? So guess what? Now they get affected emotionally, and they got this fear that what they have is going to be taken away. So the next trade they go in, which is this trade, stop loss at 1R, okay, profit target at 1.5R, all right, and they enter the trade and it goes up, okay, and say it goes up to here. Right? No, let me do that again. Sorry. Okay, so they enter the trade here, right? It goes up to, let's say, instead of 1, it has not hit the profit target yet, but say it's up to 1R here. Example, so 1R, okay? And it goes up to 1R and it starts to come down. They see this red candle and they say, oh, I've seen this movie before. I remember this, right? I had some money, but I lost it. So shit, I better get out, right? So they quickly They quickly sell, right? They quickly get out even before their stop loss is hit, profit target or hit. They intervene, they get out because they're watching the market, right? And I keep saying this: once you're in the trade, don't watch it, right? Go fishing, do something till it hits your profit target or stop loss. Because when you watch the market goes up and down, you get very emotional. You're bound to intervene. All right, sure enough, you intervene and you sell and you get your 0.7R. All right, at least got some money, right? And then after you sell, it goes down. Luckily, I sold it, right? But you know what? It doesn't hit your stop loss. And then boom, it goes up and it hits your profit target. And you look back and say, damn, if I had stayed in trade, I would have gotten 1.5. Now I only got 0.7. Shit. So what happened? Because of your past conditioning of your past 3 trades, now you took profits too early, and instead of getting 1.5, you got 0.7 R. Now, if you keep repeating this pattern, guess what? You keep getting trades with smaller wins. Instead of the usual 1.5, you get 0.7, 0.5, right? And what happens? The moment you do this, your trading system no longer has a positive statistical expectancy, because in the long run, your wins can't cover your losses, because your loss is always going to be 1R, or your win is going to be less than 1R, or not enough to make it worth your while. All right. So what happens is you could get this outcome. Okay. So again, by taking small profits and not allowing winning trades to achieve their fullest profit potential, your system will no longer have a positive expectancy. Your profits on the wins may not make up to cover your loss on the losing trades. So you may end up with this outcome where you get 1, 2, 3, 4, 5. You get 5 winning trades, you get 3 losing trades. You should be a winning trader. You should be making money, but you're not, because, right, if you add up -3 and you add up the wins, this can't cover the loss. So even with more wins than losses, you still end up with a negative expectancy. Okay? So this is a very, very common mistake that people make. Now, the next one is hope. Right? I like to say that in life, it's good to have hope, right? Hope your children will listen to you. Hope you have good health, But in a market, never have hope, because in a market, hope is for the hopeless. Hope kills you. Hope destroys you in the market. Have no hope in the market, right? Only in life. Okay, let me tell you why. So let's imagine the first scenario. You bought there. Your stop loss is here. That's 1R risk per trade, right? And the moment you buy, what happens, right? It goes down, it hits your stop loss, and right there and then the price zooms up. Okay? Now, how do you think most people will feel at the point of time? Damn! It was a winning trade. My stop loss was too close. Okay, or I'm just unlucky, hit my stop loss and the market's teasing me, the market's screwing me, someone up there hates me. They get all emotional, right? So what do you think they're gonna do the next time? Next time, I'm not gonna put a stop loss. Real men don't put stop loss. Someone once told me that, and now he's bankrupt. Okay, or they say, next time he's gonna hit the stop loss, I'm gonna move my stop loss and give myself more time, right? And sure enough, what happens the next time? The next time you buy, you place a stop loss there like a good boy. Oops. And sure enough, what happens? You've got your predefined risk of 1 hour, your predefined risk. But the moment you buy one, but it goes down, you're watching the market, which I said, never watch the market when it's open, right? You watch the market, it's going to hit the stop loss. Oh my God, I remember watching that movie before. It hit the stop loss and it went up. You know what? So I got to move my stop loss. So you shift your stop loss down to give yourself a bit more room. And sure enough, what happens? It goes up, yes! Oh my God, it goes back down again. It's going to hit my new stop loss again. What do? Shift my stop loss lower, give myself a bit more room. I know it's going to recover, it's going to go up, it's going to go up. But it doesn't go up until eventually, oh my God, I'm losing too much. Boom! And instead of losing 1 hour, you lose 4 hours and 5 hours. Right? And that's why there are some people with, I know some people who win 9 out of 10 times, but the one time they lose, they wipe everything out because they didn't predefine their loss. So in trading, we always say that manage your losses and the wins will take care of themselves. Okay? So big loss, that's right. So remember that the overall outcome of a trading journey will not unfold linearly, right? Your capital will not go up in a straight line. It just doesn't happen. Your money just doesn't go up like that. Nothing goes up in a straight line in real life, okay? So do not look at the trading outcomes in a certain period and extrapolate results forward into the future. So this is a typical equity curve that you can expect as you trade. From say 10 grand, as you trade, it may go up to 50 grand, right, over say 100 trades, whatever it is, depending on your risk, right? So notice that there'll be periods of time like here where you have what I call a drawdown. A drawdown is a fall in your capital as a result of losing trades, which are inevitable. So you have got losing trades in a row. In this case, you had 5 losing trades in a row. 5 losing trades in a row, right? 5 losing trades in a row. It's going to happen, right? And the trouble with many people is that once they have got this 5 losing trades in a row or 6 or 7 losing trades in a row, they start to say, if I continue like that, I'm going to lose everything. So they start to extrapolate forward and they generalize. At the same time, if you get a string of winning trades over here and say, oh, I got 5 wins in a row, if I continue doing this, I'm going to be a millionaire tomorrow. Right? And they extrapolate, not knowing that the market is not linear, doesn't go up in a straight line. The market goes up and down. That's how the market is. So we should neither be discouraged by losing streaks or carried away by winning streaks. In the long run, losing and winning streaks will even out each other. It is the long run distribution of wins and losses that will make us profitable. And the long run performance, our long run performance has got nothing to do with luck. Nothing. In the short run, I can say it's all luck. Right? You place 5 trades, you win, it's luck. But in 100 trades, 200 trades, it's not luck. It's skill, it's psychology. Okay? Let's review some of the common emotional mistakes in trading. So you may want to print it out, paste it on your wall, and notice if you are doing that. If you're doing that, you got to stop it. All right? So common emotional mistakes. What do losing traders do? Losing traders rush into new trades after experiencing a few losers in order to quickly win the money back quickly. That's a very common mistake, right? When a trader makes a few losses, they say, I gotta take the next trade quickly to make back the loss. And they start to take low quality trades that do not meet the rules. But they say, I gotta take it to just make it back to break even for the day. No, that's a mistake, all right? Or the opposite, right? After having a few losing trades, they then have the fear of taking the next trade, right? They look at the next trade, the signal is there, but they don't take it. They say, because what if this one's a loss again and boom, turns out to be a win and they were not there. Or losing traders stay in a losing trade hoping things will turn around, right? And not having a stop loss. Losing traders focus on short-term results and lose their perspective. Losing traders fail to stick to a consistent percentage risk per trade. Winning traders always risk the same percentage, 1%, 1%, 1%, or 3%, 3%, 3%. Losing traders, right, when they start to have a few wins in a row, they say, hey, I'm good, I'm on a winning streak. They raise their risk per trade from 1% to 10%. And the moment the winning streak ends and the losers come, the losers wipe out all their winners. One loss of a 10% risk wipes out a few wins that they made early on with a lower risk. And some traders, when they start to lose, right, they say they risk 2%, 2%, they lose, and they start to say, okay, the next one I'm going to risk only 1%. And when the wins come, it can't overcome the losses because they keep changing their risk per trade. Okay? Losing traders constantly change their trading systems and strategies after experiencing short-term losses. Right? So the moment they get a losing streak, they say, let me add a MACD there, let's add a stochastics, right? Let's change the strategy altogether. Let's go trade Forex, stocks, options, and they go around in circles forever. Losing traders focus on the account balance instead of following the system. They keep looking at their equity going up and down, they get very emotional, instead of following the process of the system of placing good trades and letting the equity grow by itself. Losing traders get emotionally affected by losses. Again, fear, frustration, stress, loss in confidence. Losing traders always blame and find external reasons for their losses. I lost this month because the market was bad, because the Federal Reserve increased interest rates, because of my bad luck, because of my bad feng shui or my 八字 or whatever crap. Okay, losing traders have the need to take revenge on the market after experiencing a loss. They lose money, I'm going to take revenge on the market and make my money back. Okay? Quite a revenge trading always ends up worse, right? Losing traders will trade with methods that do not suit their personality. And too often people will hear of another success out of envy or lack of self-confidence, and they feel compelled to copy someone else's trades. And you'll end up with a loss. Because you must always trade with a system that matches your personality, that you have tested, that you have learned. Okay, so what are the habits of successful traders? The complete opposite, right? So winning traders are winning traders because they always take action when there's a valid and high probability signal, without questioning, without hesitation, without reservation. And these are the words of Mark Douglas. The late Mark Douglas was one of the best psychology coaches in the world, right? He always said, you have to trade without reservation, without hesitation, without fear, and that's when you trade in the zone, right? So winning traders don't let their fear control their decisions, and they don't let it interfere with their trading. Successful traders take responsibility and learn from their mistakes and move on. They don't dwell on setbacks. Successful traders expect and accept losses as part of the game. Right? Losing is necessary to win. So they don't get upset when they've got a losing trade. Part of the game. Successful traders focus on following the trading system, and again, not the immediate money they're making. Successful traders think statistically and keep a long-term perspective. Successful traders focus on being consistent in applying the rules. All right? Both exit and entry rules. Okay? Successful traders are patient. They only wait for high probability opportunities. Right? And remember, at the end of the day, the biggest enemy to your trading success is not the market. The market is not against you. The market doesn't know who you are. Right? Don't get too egoistic. The biggest enemy to your trading success is you. Right? So again, let me reiterate. A good trade is one where you follow the rules of the system and not one that led to a profit. So finally, let's talk about managing drawdowns. Right? So what are drawdowns? Again, drawdowns are a reduction in your account equity or your capital from a losing trade or a series of losing trades that are, again, inevitable in trading. No matter how good a trader you are, you're going to have losing trades in a row. All right? At the same time, winning trades in a row. Okay? And drawdowns are the main cause of psychological damage to traders and their success. Okay, so again, from a 10,000 account to 23,000 doesn't go up in a straight line. You'll go up and down and up and down and up and down, right? And a lot of people, when it goes from 10 to 15 grand, they feel good because the anchor was 10 grand, right? But when it goes from 15 to 12, they feel bad. Well, why the hell should you feel bad? You're still up 2 grand, right? But people tend to anchor that I was at 15, I'm now down 3, I feel bad. So they go through this emotional roller coaster up and down as they trade. And I can tell you, emotionally, it's not sustainable. If you're like that, you can't trade for long because it's going to affect your relationships, it's going to affect your health, it's going to affect your mental state of mind, right? I know people who, they trade, they get so emotional, and when they look at the trade going up, they feel really happy, right? The food tastes better, they go back and pet their dog, hug their kids. Next time they look at their account and the trade's going down, they're losing money, they get upset, they kick the dog, they shout at their wife, right? And it messes up their whole life. They get a nervous breakdown, right? So I can tell you the only way to survive long term in this business is to trade like a robot. And the way I do it is I don't look at the market once a trade is in. Once I place my entry, my stop loss, my profit target, I leave it there and I let it hit the profit target and stop loss. And the broker will send me an email to tell me, hey, your trade is closed. I'll then see either plus 1.5 R, minus 1 R, I move on. I don't care what happened in between, that it went up, it went down. This market noise, there's no point looking at the market. You can't make it go up by looking at it, so don't look at it. Go fishing, do something, have a bloody life, right? So I always tell people that, you know what? The irony is this. As a professional trader, you don't have to work anymore once you're successful, right? You can make enough in the markets to cover all your expenses. But I tell people that you should always have a hobby, right? Like one of the best traders I know, his name is Kyung Hee, and he makes $250,000 a year, a month, $250,000 a month, $500,000 a month as a trader. And he does like 10 trades a month, right? And he could not work, right? But he still works, right? He still teaches people through courses. He teaches his son, homeschools his son, and he's very active in the church, right? And it's important to always have a hobby. It's always important to have another job to keep you occupied. Because if you don't do anything else but trade, trust me, you will look at the market. And that becomes counterproductive in trading. And that's why I teach myself. A lot of people ask me, they say, Adam, why are you teaching these courses? Why are you running your business? Why don't you just trade? Because I want something to occupy myself, to distract myself from the market. Because looking at it more and more doesn't help you. It goes against your trading process, all right? So I digress, okay? But the point is, how do you condition your mind to manage drawdowns? Well, the way I do it is that I think of trading as a business, okay? And to me, in any business, you can have sales and costs. If you're selling clothes, you're selling a dress at $100, costs you $50 to buy the dress, you make $50 in gross profit. Your profit margin is 50%. Any business, sales and costs. As long as sales is more than cost, you have a gross profit minus your operating expenses, you're in the black, you're making money. Trading is a business. So to me, when I have a losing trade, minus 1 R, I don't think of it as a loss. I think of it as a cost of goods sold. And I never think that I lost 5 grand, I lost 10 grand, I lost 1 R. So when you think in terms of R and not money, you are emotionally disassociating yourself. You're shielding yourself from the emotional feelings that most people have. All right? So don't focus on the monetary value, focus on accumulating R multiples. Minus 1 R, minus 1 R, plus 1.5 R, plus 1.5 R. At the end of the month, you have a positive R. Okay, and again, treat a small number of trade outcomes as statistically insignificant. So again, when you have a winning trade, it's a sales, losing trade is a cost, and that's your gross profit. That's it. And the great thing about trading is there's no operating expenses. Well, not much, right? Except your internet fee every month, right? You don't have to pay rental, no staff costs, no inventory. It's one of the best businesses to be in. Okay? And let me quote Bruce Lee as one of the last lessons about psychology of trading. Many people, they learn hundreds of trading strategies, hundreds of indicators. They go around the bush. And you know what? To really succeed in trading, all you need is to trade one strategy. That's it. Or the very most 2 strategies. I found that the best traders in the world focus and niche on one strategy, one system, at the very most two. That's it. They don't trade 100 systems. Why? As Bruce Lee said, I fear not the man who has practiced 10,000 kicks once, but the man who has practiced one kick 10,000 times. So it's about sticking to one strategy, being a master in it, an expert in it, and that's how you win in the markets. Right? So that concludes our lesson 6, Psychology of Winning Traders. Adam Khoo here, and I'll see you in the last lesson.